Hi guys, hope everybody's well. I can see a few more people still joining, so let's get started. I'm just waiting for Kevin to join us as well. We're just logging in. But yeah, we'll look to get started then on this sunny afternoon in Warrington. So we share with you some of the key differences between SIPP and SSAS. So this is part of a mini series that we've put together. Talking mainly sort of about pensions, investments, particularly property, and how they kind of work together. And I know quite a few people came back and had questions about SIPP, so we thought it was a great way of putting it together. Question there from Doug already, so I was quite keen getting the questions in early. So yeah, Doug, appreciate you might have to shoot off at some point, but yeah, there will be a recording sent round for you to review as well. So that's absolutely fine. There we go. We've got Kevin on board as well. Fantastic. And Colin with us. Right, gents. So yeah, so we'll jump into it then. So it's 12:30. Thank you everybody for joining us. I see there's a few people still coming through and some familiar names as well. As I mentioned a couple of moments ago, this is a presentation about the key differences between SIPP and SSAS. This is brought to you by Source Capital and Wealth Builders. So I'm going to do a little introduction first of all, and talk about the guys as well. So I'm going to move some of my views out of the way. So bear with me 1 second. So Source, yes, anybody that's new to Source, who we are, what we do. Ultimately, we are a property company. We have 5 key divisions in our business. We've got Source Property, so we sell investment properties. We're averaging about 50 per week. We've got Source Developments, so we're building properties and developments across the UK. And we've got Source Capital, which is what we're bringing the presentation to today, which is our peer-to-peer lending platform. We have Source Franchise. We've got this fantastic network of franchisees across the UK, identifying investment properties, working with investors, and building and creating their own wealth as well. We've got Source Care as well, so finding, identifying properties in the care sector. So anybody that's new, a little bit of an overview of who we are, Source, and the areas of ourselves. Kevin, if you'd like to introduce Wealth Builders. Hopefully.
This mic's
There we go. Oh, his mic's not come on. Let's have a quick look. Kevin, can you, I presume you can hear us? A couple of technical difficulties there, guys. So bear with us 1 second, please. See if we can change anything there. Kevin, can you hear us? Oh, I think he's logged out. We're coming back in shortly. So I'll touch on the Wealth Builder side just to give you a little bit of information. I'm sure Kevin's going to cover this anyway when he's logged back in to give you a bit of an overview. So apologies there, guys. But yeah, we've actually done a couple of webinars, podcasts with Wealth Builders. As it says on the slide, home of the 7 Steps to Wealth program. Kevin's obviously going to give you a much better overview of this when he's able to join us properly. Ultimately, they cover how to create, build and protect your wealth. Home of Wealth Talk podcast, free membership community as well. We work with a number of people in the pension sector, and we find obviously Wealth Builders particularly good. Kevin's very, very switched on. And I'm sure obviously some people that have logged in today and following us have seen Kevin talk before in the past. So hopefully he's going to be back on with us. It's going to be the shortest webinar ever if he's run away. He must be having some internet issues because I know he's struggling a little bit logging on. I don't know if you want to give us an introduction yourself, Colin. Just jump into yourself in terms of, do you want to give us a quick hello, who you are, Colin, because you're also one of our speakers as well.
Yeah, no problem at all. Well, I started off life as a biochemist And then I gave that up and went into computer software development. And I ran a company for about 20 years, selling in about 60 countries around the world. As a student, I actually set up and ran what we now called HMOs, which we then called student accommodation. We're sharing with 5 or 6 students. But I didn't stay in that for very long. And in 2000, I sold my company. And from that, I went into property development. I had a large house office, and I converted that into flats and houses. I started off small with an extension to a semi-detached house. I got my hands dirty because I wanted to know how you did things and how hard it was to dig trenches, etc. Having discovered that and discovered that you'd never do anything by hand, but you get machines, I went on to demolish. I think it was a bungalow, and we built 3 terraces on that. I bought a plot of land against a large house. I then went on to build 14, 20, 59 sets of flats. I've designed, but not built, ice rinks and sports facilities. I also designed a carbon neutral mixed use complex. And I then went off and bought a hotel because I had a sum of money in my SIPP, and it was just sitting there doing very, very little. I didn't really want to invest into stocks and shares. I found that offices were fairly boring, so I thought hotels would be a fun thing to do, and I actually bought one and then ran it for about 5 years. I then sold it a couple of years ago, having set it up as in the SIPP. The hotel was stood. Now the SIPP's not allowed to hold FF&E or fixtures and fittings, so I had another company that held that, and then I had an operations company. So if anything went wrong, it was the operations company went down, not I wouldn't lose the hotel. Having sold that, I then went on a cruise for a couple of years to be confounded by COVID. I recovered from COVID, and then suddenly realised that my daughter was 22 and she was coming out of university this year. What was she going to do? Did ask her, and then I said, well, do you fancy getting into property? And she said yes, which surprised me. So I thought, okay, well, I better do something about that. And I found out about this company called Source, and thought, oh, well, they can teach me how to develop things I thought they'd be able to teach my daughter. So I decided to join Source, and that's where I am at the moment. And having chatted through with Source about the difference between SIPPs and SSAS, decided to go the SAS route, but I guess more of that later.
Yeah, fantastic! Wow, what a real mix variety of experience. Absolutely brilliant. So really good insight. And as you say, Colin, we're going to jump back to you later on to find out more about your experience with the SIPP and SAS journey, I suppose, ultimately. Kevin, are you able to hear us, and can we hear you now? We still can't hear you, I'm afraid. You're unmuted on our system. You're now muted. I think you've just muted yourself. Sorry about this, guys. No, unfortunately, we're not able to hear Kevin. I know you've tried to log back in. I'll tell you what, I'll try something here. Just try and change the order. Let's try and make you host. Can you try now, Kevin? No, it must be something to do with the microphone, ultimately.
I've changed the microphone.
Oh, there we go. We're back on. We can hear you. Whatever you just touched then has worked.
The microphone, so not to worry. Look, sorry about that, but I've got 2 mics and both of them were working perfectly fine. Nonetheless,
locked and loaded.
I'm glad to be with you, and thank you, Colin, for stepping in at short notice to fill a gap while there was an apparent lull in the technical side of things. But all good now, I hope.
Well, the good news is, Kevin, I've completely sold Wealth Builders. So everybody signed up for you, so we're done now. So we can go for lunch.
I'll have an early afternoon.
Yeah, I mean, we've just touched on very briefly, obviously, Wealth Builders. We kind of jumped, I suppose, ultimately to the next slide, which was more of an introduction. Colin very kindly jumped in and gave an introduction to himself. I've introduced Source, the business that I'm managing director of. Personally been a property investor for about 20 years. And as I mentioned, yeah, MD of Source. So I think for me, property is more of a passion. I love how creative you can be with property. and how you can utilize your imagination for it. Kevin, it'd be good to hand it over to yourself, and if you could give us that introduction.
Sure. So I'm the founder of Wealth Builders, and Wealth Builders is a community of like-minded people who are all looking for multiple streams of recurring income. So no one's trading time for money. Everybody's looking to create typically a £10,000 a month level of income coming from a wide range of different assets. And no secret at all that the combination of property and pensions, one of the best kept secrets, Stephen, is the one that's probably least well understood. So always grateful for the opportunity to share that. And more often than not, the pension funds of individuals themselves and those of other people can be a very, very powerful source of funding, not just for projects, but also in things like peer-to-peer using places like the Source platform. Yeah,
fantastic, excellent. I know you're going to kind of kickstart the presentation, Kevin. Are you able to move the slides? You should be able to. We've set you up, so hopefully you're up and running.
If you've given me control, let's just see if you have. I'll just request the control. I'll do that now. Yeah. So if you've given me permission, Stephen, I should be able to move it on. So, so thank you for that. I'll just check that in one second. But I guess the point here is just that for those people who want to check my credibility, I'm the author of 3 different books. So I'm not going to dwell too much on that. Okay, why isn't it? Let me move it forward. There we go. That's you, Stephen. Running a poll. So I'm going to cover the key differences then between a SIPP and a SSAS. They often get confused. They often sound the same. People think they're the same, but of course they're not the same at all. I'm not quite sure where you are, Stephen, on your on the. Doesn't seem to. There we go. It's a very.
Okay. It must be a slight. Yeah, it must be a slight delay there, but yeah, we can see the slides absolutely fine. Yeah, I think we're up to speed. So yeah.
Yeah. It feels like we're on an exchange link, when I'm doing a speech for receiving an award from America with a 7-second delay or something like that. I'll just try and be mindful.
I've not been there myself, so you'll have to tell us what your experience has been like.
So I'm going to cover some of those key points there, which essentially is to try and give you a framework for you to work out the key differences. Now, there are some similarities, of course, and well, you should be able to work it out from here that the self-invested personal pension, which is a bit of a misnomer, as I'll come on to, and a small self-administered scheme, the key in both of them is the word self. In the SIPP, regulated by the FCA, it's a product, really. It's a product that is a regulated box, and in that box, you can do certain things. And this is where the self-investment kind of comes in. There are some restrictions given that the FCA regulates it. So that regulation limits it to some things which they will allow and some things which they won't allow. And one of those, interestingly, Stephen, is peer-to-peer. It still seems to be, again, a poorly divulged secret in the world of SIPs. Most SIP providers struggle with that one. The small self-administered scheme. Go on.
Sorry, Kieran. I was going to say, I think a lot of that is driven by typically with the SIP, and you probably be able to explain this better. You've got to have IFAs involved, and IFAs generally don't get involved in peer-to-peer because they don't get paid commission, and that's the key driver behind it, which is a shame.
I think there's something to be said about the concept of intermediation. That wherever there's an intermediary involved, then by definition you've got to work within the scope of the knowledge and the interest and perhaps the preferences of being intermediated, somebody guiding you, right? So whereas the small self-administered scheme, small means less than 12. So that's why it says small. It's not regulated by the FCA, it's regulated by the pensions regulator, or TPR. And all schemes are approved by HMRC. It's like getting a driving license. And I'll keep that analogy going, Stephen, during the course of this, I think, because, a SSAS is it says self-administered, but it isn't really. It's self-directed. I think I wouldn't probably wouldn't give any of these great prizes for marketing titles. You know, they're not the sexiest titles in the world. But self-administered means basically a small scheme up to 11 people where you decide, like a business, to run your pension. And the word for pension in law is scheme. So that's the reason why they kind of have some similarities, but I think the similarities pretty much end there. There are so many things that you can do that are different, and I'll cover those. So in terms of a vehicle, I think a pension, you would argue, is a vehicle. It's meant to try and get you to a place, typically of retirement, but as we'll discover, there are so many more points of access earlier than retirement. But in terms of a vehicle, with the SIPP, essentially you're borrowing somebody else's vehicle. So a pension is a trust fund, and a SIPP is somebody else's trust fund. So how do you know? Well, because it will say the name of the trust fund on the documents, whether it's Hargreaves Lansdowne, whether it's Aviva, whether it's whoever. You know, you'll see the name, and it's the name on the letterhead, the name on the report that says we decide what you can do within a range of our preferences. Now, with the SSAS, you own the vehicle. It's essentially a family trust. So not just owned by one person, as we see in this sort of cartoon character here. A SSAS is a vehicle, as I've already said, for up to 11. So it's genuinely either a large family, small business, you know, people collaborating and connecting with each other, whereas a SIPP is typically a vehicle for just one person. And here's the key. With a SIPP, somebody else tells you what to do, so you're responding to somebody else's business. Whereas a SSAS, it's your business. Essentially, you run it like a business, like a board of directors, a board of trustees, a set of documents to create it, a set of documents to run it. You make profit in a company, you make tax-free profit in a SSAS, and more of the tax-free benefits in a little while. Both are tax-free, both are pensions, so they are tax-free. And there are definitely pros and cons of each. I'm not going to say for everybody a SSAS is right, but certainly if you're a business owner, you're proactive, you've got a limited company, you've got other people you want to work with, or indeed you can do it on your own, then a SSAS is a reflection of your business, not somebody else's business. So
it's a great analogy, that, Kevin.
Yeah.
Really well explained.
Yeah, well, thanks, Stephen. And I don't know about you, but you know, we're both business owners, and I don't think I would kind of like my business somebody else to say, this is how I want you to run your business. So you know, I'm probably biased in that regard. I'd kind of like having the freedom of control, which is one of the reasons why I became a business owner in the first place. So I would like a pension to that kind of thought process, really. And a lot of people will say, particularly IFAs and other people who perhaps don't know all the details, and this is why it's great, Stephen, you've given a platform to get this aired. And by the way, we've shot a video about all about this so people can dive into it at their leisure as well. But a lot of people will say, well, surely if you're running your own pension, you're going to take on more risk. Surely. It's got to be more risky. And I would say the risk is the same. It's just a vehicle. And like with any vehicle, the risk, as Warren Buffett said it so elegantly, risk is when you don't know what you are doing. More often than not, when you put things in a SIPP, you don't really know what you're doing. You're giving it to somebody else to run. And, you know, we've seen the crash in the stock market several times. The fact with the SSAS, then, you're not limited to the stock market. You've got so many more choices. And we'll talk about property because I'm sure that's the most popular thing. But it's about being a skilled and well-trained driver. It's a very powerful vehicle, the SSAS. So you need some instruction. And I'm pleased and proud, actually, to say we are the provider of unbiased and holistic education for people who want to be genuine, confident, and compliant trustees. And I think it's really important that you can't just be a trustee, you've got to learn how to be a trustee. And I think that's part of the reason why it takes a while. You've got to get You got to become interested. In a SIP, you can basically stick it on autopilot. With a SSAS, you generally have to get involved. And we say you probably need at least an hour a week. If you can give it an hour a week where you're thinking about your pension, you could probably manage all that you need to manage in a SSAS. It's not overpowering, overburdensome, as many who don't like SSAS will tell people it is, but it isn't. As many of the thousands of trustees we work with will testify, you're just running your business. If you can run your business, this is just a part-time activity alongside your business.
No, that's really interesting, Kevin, in terms of as well, ultimately you get out of it what you put in, don't you? And, looking at the SSAS, I know when I first looked at SSAS, it's kind of this minefield, isn't it? You Google SSAS and, there's all kinds of stories and, there's negativity, positivity, there's all kind of mixed emotions, but then ultimately it does come down to actually, did this person know what they were doing? Did they educate themselves correctly? And it can be quite hard because I don't think the HMRC, I know when I've dealt with them, looking at, what options are, ultimately they're very much standoffish, just refer to the guidelines and that's it. Having a company like yourselves that you can provide that training and break it down to, a level where people can digest it and say, right, okay, it makes sense now, move forward. That's the big plus, I think.
Yeah, and we have an education suite that, people can dive into. We're not trying to make people pensions experts. We're not saying go to bed with a pension tax manual, and have it by your bedside every night. It's not about that, because like anything in life, and you need expertise on something. I don't think many business owners are tax experts or legal experts. You will use lawyers and accountants to do that. In some cases, if you know enough, your SSAS is really just a bookkeeping exercise, because it's just keeping records of what you decide to do. And you're right, you get out of it what you put into it. And the same with business. And business isn't regulated by the FCA, but that doesn't mean there aren't 6 million business owners in the UK. What, they're not regulated? No, but they tell the truth. They do the best in business they can, and they comply with the law. It's exactly the same thing here. What mostly people get confused about is the investment choices. Like, what can I actually do in a SIP, and what can I actually do in a SSAS? So here's a graphic that might help that, Stephen. And we'll focus on property. I mean, there are many things you can do. I'll come on to that in a while when we talk about alternative investments. But because property is the most popular way people build wealth in the UK, it's easy to follow, it's easy to replicate, it's secure, it's tangible, all of the things we have a love affair with property in the UK about. But in a SIP, it's still a good vehicle, A SIP can still do a good job. SIP can buy into care homes, it can do commercial property. A lot of business owners have got SIPs where they're running a widget manufacturing company and they use the money in their pension to buy the factory, so they manufacture more widgets. So nothing wrong with that. And then they become the landlord and tenant, and they're getting a rental income from the property instead of sending a rental income to a third party. And similarly, industrial units, offices and shops, not so much in terms of, when you've got shops down below and offices up above, that's different. But certainly offices and shops, not shops with resi up above, that normally would come into what a SSAS can do. So a SSAS, in addition to what a SIP can do. So here's the thing to know. A SSAS can always do more. There is nothing, I'm going to repeat this, nothing that a SIP can do a SSAS can't do. But there are so many things a SSAS can do, a SIP cannot. So the key then, when you're doing your research, is to work out, well, what are the pros and cons to me? And certainly from property, there's such a huge demand now for commercial to residential, particularly with changes in planning law, serviced accommodation, supported living, and shops with tops, as we call them. I could have put that down as well. I mean, it's not an exhaustive list even by any means, but as I say, a SSAS is a plus. It's not a SIP can do these 4 things and a SSAS can only do these 3. It's all of them.
Yeah.
And virtually nothing in property. We could have put land down there. There's so many things we could have added in there, but for the sake of at least giving people an idea, it's always plus.
It did make me smile, to be honest, Kevin, when that slide came up.
You what? Sorry.
Sorry. Yeah, I was going to say it did make me smile seeing that come up, because I think you just missed Colin's introduction And I think if we were playing SIPP and SSAS bingo, then Colin would have shouted house, because he covered virtually all those things on his introduction of what he's
Oh,
done.
right.
So
Okay. Well, good for Colin. So
good
and
to hear.
nice
Yeah.
nice to be connected with you, Colin, as well.
Thanks,
So
Nick.
one of the things that both can't do, you can't hold residential property in your SAS or your SIPP, right? So residential property, the ownership and the retention of residential property is always a no in SIPP and SAS. That's no different there. I mean, it's still a pension after all, and the government doesn't want to do that. Now, there are ways, of course, that the SAS can facilitate, but we'll get onto that during the course of the time we've got today. So turning to the stock market and funds, generally speaking, as you say, Stephen, a SIPP is an intermediated service. In other words, there's normally a broker involved, getting involved, an advisor of some kind. And there's nothing wrong with being a retail customer and nothing wrong with having advisors, nothing wrong at all. There's just the point that with SAS, you don't need them. So you can choose to have them or you choose not to. You choose to spend your money on advice or you choose not to. It's entirely a matter for you. And in some respects then, with a SIPP, you're a retail customer pretty much. That's what a SIPP is there for. And a SAS is a more sophisticated customer generally, and therefore they're buying or able to buy funds wholesale, and therefore they can buy them without the intermediation. And the typical difference in cost, most retail owners of funds probably will be paying an average about 2% for the ownership of stocks. So if they're getting, say, I don't know, 6% or 7 or 8, doesn't really matter what it is, they're still going to be paying between 1.5 and 2 for the kind of whole intermediated service. Now, that's quite a sizable chunk of the total. I know it sounds small, but it can be quite a lot. We'll come on to costs as well a bit later. But with SAS, you're not really doing that because you don't need the intermediation. You can usually buy things like low-cost fund options, super low-cost tracker funds or exchange-traded funds or ETFs. You can get access to low-cost platforms like 0.1 instead of biggest SIPP in the UK, 0.45. It's like 3 times cheaper, to choose your own platform than it is to take one that is really typically sold to retail clients. And also you can put in risk mitigation in a SAS. You can do stop losses. You can put in a whole range of different things, options and puts and calls and many things beyond the scope of this conversation, but you can just bring so much more into play when it comes to stock market. And of course, we all know about the stock market. Did you want to do a poll there, Stephen?
Yeah, I think we've got a poll that the guys have put on just to see. It might be yourself actually, because you're controlling the. Let's have a look. We should have a button.
Not letting me move that one forward.
No, I'm not sure why it's not. We're having a few technical difficulties today, aren't we? But that's fine. If you want to go on to the next one, Kevin, are you able to click onto the next one?
Yep.
I'll
do
cool.
my best.
That's fine.
Kind of not letting me do that now.
Oh, that's okay. Let's see what's changed.
Make sure. It says I can control it. Let's try. There we go.
There we go.
I'll just go back one. There we go. So when it comes to alternative investments, Stephen, there's a big issue with SIPP. This alternative investment often is the language they use is called non-standard investments. In other words, a SIPP provider being regulated by the FCA, aimed at retail clients, has got to hold capital adequacy. Hard to say that, get your teeth in. Capital adequacy. So anytime people want to invest in things that are not standard, like this list here, then they have to put money aside in case the retail client ends up complaining. Now, with the SSAS, you don't need to do that because you're making the decisions. You're not part of a group or not part of a whole range of other people inside the same trust. It's your family's trust, the Whelan family trust, the Warburg family trust, the Moss family trust. It's our trust. So there's no toxicity of leakage between one trust and another trust. So we can have these investments. If we want to invest in peer-to-peer, whatever platform we want to do, whatever due diligence we do, we're able to do it. If we want to buy unlisted shares, even shares in our own company, we want to boost our own company, we can do that. We can buy precious metals like gold, and you can also, trade in these things, and of course, cryptocurrency. And there's such a huge demand, as there will be over time, as the whole kind of blockchain takes hold of what's going on in the nature of finance and the nature of the world. There's going to be a greater demand.
Definitely.
For that. It's going to still remain way outside the scope of SIPs.
Yeah, absolutely. It's interesting that you've put cryptocurrency on there, because I saw that on a chat online last week, and someone was asking about, can we buy cryptocurrency using our SSAS, and it kind of blew up the whole chat. It's the kind of opinions coming from everywhere, and the experts, etc. But it is. You're right. Things are changing, and ultimately, it's a great way that you can, take the get the benefits of that, I suppose. Ultimately.
I mean, as you said earlier on, the risk is if you don't know what you were doing. You can make a bad investment. Just because you can do doesn't mean you should do. You have to do due diligence. But this is the point. We're grown-up people. We're, ideally people who are paying attention to what we do. And instead of delegating our money to third parties and hoping for the best, we're getting involved in making decisions about what we want to do for ourselves. I'm not saying to anybody, you should do any of these things. You don't need to do a SSAS. You don't need to do a SIPP. You could have a personal pension if you're happy with what you're getting. But more often than not, these two terms are used interchangeably, and that's why I wanted to clarify it. I'll just go back one. It's just a little tricky on the remote controls, all I'm saying. It's a bit like driving somebody else's car. You're not always quite sure of how it's going. Let's talk about collaboration. Collaboration, to me, is part of the way to build wealth, that people are often doing things together. Now, in SIPP, it's a vehicle for one. Generally speaking, it's a SIPP is a one-person vehicle, whereas a SSAS is up to 11. So it means you could have husband and wife and kids, kids over 18. It could be business partners. It could be siblings. It could be a whole host of things. Now, when you bring more money, if you imagine 5 or 6 people bringing their pensions together, what you've got then is much more access to funds. And because you've got more funds, then you've got more buying power. And it also means, because you can get leverage as well, you can use a bank, you've got leverage on your side, as well as the leverage of other people's money. So the real power is you can, if you want to, collaborate. You could have a SSAS with one person. We've got some of those. More often than not, it's 2, usually husband and wife or 2 business partners. But, there is real power of collaboration. Whereas I say the SIPP is generally a one-person vehicle. The other form of collaboration is the way that people can work together. So SIPs can work together. I've seen SIPs try and organize themselves to buy buildings and so on. But it gets a bit more difficult there, because each different SIP, you've got a different trustee who's the owner. And by the way, just a point of interest, the definition of a trustee is the legal owner. So if you've got a trust and it's somebody else's trust, they are the legal owner of the asset. You're the beneficiary of the asset. I don't know. I don't feel very comfortable with somebody else being the legal owner of my asset. Anyway, enough of that.
Yeah.
But the problem there, though, is when you've got multiple SIPs trying to work together, somebody wants to be the boss. And somebody's going to say, well, who's in control here? And it just makes the whole plug and play thing. You know how we've just talked about the difficulty of my machine plugging into yours today. It's a bit like that. It's just awkward and sometimes even impossible. Whereas SSASs
Right.
can collaborate really easily because it's individual trusts. So you can combine and collaborate on the inside or on the outside with multiple people all coming together with their own SSASs. All right, so very
Right.
powerful thing. And the
Yeah.
other value is lending. You know, if you want to invest money, say you like a source project, or you would like to lend to someone like Colin or anybody you would care to do some due diligence on, then you can do that with a SSAS very, very easily. But with a SIPP, generally you can't, because the SIPP trustee would regard it as a non-standard asset and consequently would either forbid you from doing it or put excess costs in there. And, you know, I've had this experience myself. One of the reasons I changed from SIPP to SSAS, I'm a qualified IFA, Stephen, by training, so I can deal with personal pensions, SIPPs and SSASs intellectually and in actuality. Why do I choose SSAS? And it's not because it's self-serving to me, it's because it gives me all the control that I want. But what you have to do is check what control you want to decide whether this collaboration, as an example, is something that's meaningful to you, or whether it isn't and you're quite happy to just do one thing. Now, costs and charges, really important, because I hear all the time, SSAS more expensive. It's not more expensive, it's just costed differently. Because with a SIPP, you're kind of buying somebody else's product. So the cost is normally embedded in the running costs. You don't normally pay to establish a SIPP, it's just a product. But, you know, if you buy something, the long-term cost is what's the issue, particularly in a pension, because you're going to hold it for years and years and years. And in terms of a SSAS, as I'll talk about later, the SSAS you pass on to the next generation and the next generation and the next generation. So when you divide costs as an amortization, you divide it into the running costs. The running cost to operate SSAS can be so much lower than SIPPs, because all of the costs in SSAS, I don't mean all as in a lot of costs, but any costs in SSAS tend to be administration only. You know, it's the administrator doing the work of reporting to the revenue. So it's a kind of a glorified, that's probably unfair to say that. It's a bookkeeping service with some expertise. And as a result, those fees are fixed. They're not a percentage of what your fund is. And the big danger of SIPPs is when they charge a percentage of your fund. And that's why the biggest SIPPs in the UK, the owners are billionaires, because they make so much money on the back of other people's. There are no billionaires in SSASs, because SSAS is an administration service. It's not a percentage of your money. And I think it's important to know the difference between the two.
I was going to ask you about that in terms of, are there any SSASs that do charge percentage? Because I've not come across any. I have heard in the past people mention it. So no, is it just people getting confused with SIPP and SSAS?
Generally speaking, a SSAS, because it's giving you the control, it's saying we're doing the administration, which is why I say it's a bit of a misnomer. Do you remember I said small self-administered? Well, you've got to get the administration done, and that's generally what the companies are doing. So with a SIPP, generally speaking, there's no cost, because you're just buying it, right? It's just getting it off the shelf, really.
Yeah.
And if you're doing a commercial property SIPP, there can be some costs, but generally speaking, the costs are taken from the pot, and they're usually a percentage. So if you've got you can have £1 million, give or take, slightly more than $1 million, completely tax-free in your pension. If you've got somebody charging you, I mean, the biggest SIPP in the UK charges 0.45. If you've got £1 million, well, you do the maths, 4.5 grand for the running, well, for the administration, whereas a typical SSAS for the same amount of thing, if it was just stock market, would be 500 quid. That's 9 times cheaper.
Yeah.
Well, who's telling me it's more expensive? It's not more expensive. It's just you've got to establish the SSAS in the first place. So there is an element of establishment, because you're creating your unique trust. It's yours. But once you've established it, you've done it forever. And then you've got low running costs beyond that. Now, obviously, like any SIPP or SSAS, if you've got a lawyer to pay for because you're buying property, you're going to pay lawyers' fees, you're going to pay for surveys and those sorts of things. But generally speaking, you can set up a SSAS as low as 500 to £1,000. You know, it can be done very cheaply. Now, I'm not saying every SSAS is as cheap as that, because you have to decide whether you know enough. If you're just going to invest in the stock market, you could do it for that kind of fee. If you're looking to do more complex things, then you need a bit of instruction, and that will add some cost. But then people buy education in life anyway, don't they? They'll buy a property education, or they buy stock market education, or whatever they'll do. And the thing about SSAS is all tax deductible, because it's essentially paid for by the company, because you need a limited company to establish a SSAS. You don't need a limited company to establish a SIPP. A person, even a newborn, can have a SIPP, but an 18-year-old can establish a SSAS, but only if they've got a limited company, right? So, and we won't be covering every single point, but just the main differences.
Yeah, of course, yeah.
Between the two. One of the biggest issues, Stephen, I find for SSAS is this point of access. You know, everybody knows if you've got a pension, a SIPP is a personal pension, self-invested personal pension, you can't really get money out until you're 55, right? So that's, everybody knows you can get 25% at 55, and then you can draw income if you wish. The income is taxable, the cash is tax-free. Okay, same rules apply to SSAS. However, with the SSAS, you've got one unique offering inside the SSAS that a SIPP cannot do, and it's called a loan back. A loan back. What it means then is, subject to certain rules, and they're not onerous, then you can borrow or lend to your company essentially 50% of the value of your SSAS. So if you've got a 400,000 SSAS example, you can lend 200 grand to your company. You don't have to be 55 for that. You can be 25, 35, doesn't matter what age you are. And that money can be loaned to the company. Then the company can use that money to do what the company does. And that shows the connection then between the company and the SSAS. They're doing similar things. And because you can imagine in COVID, how many businesses might have appreciated the ability to lend money to their company to help. With a SIPP, you can't do that. Or indeed, if you want to use that money to build a property portfolio, if that's what your business does. So the company and the SSAS have got to be in tune. And that's one of the biggest benefits. And probably the most popular thing we do is arrange loan backs. And the interest rate on the loan back can be as low as 1 over base. With base at 0.1, you're talking about loan costs of just over 1%. Can you get a mortgage at that rate?
Yeah, exactly. Yeah.
You know, I don't think you can. So it just brings more flexibility and creativity. And with creativity comes the responsibility to understand, because these things aren't taught, and there aren't any kind of things you can just go and find out about. There are a few good people who've written some books, but you know, they're generally quite, by the very nature of books, drier. They're not giving you an experience of what happens, but nonetheless, you know, there are some books available, and I'm happy to signpost those. But this benefit I really like. So in SSAS, you know, if you think about a SIPP, all the money's in one person's name. But in a SSAS, you can start to transfer money from one party to the next. So in other words, you can build a legacy. So in this situation here, I've got 5 in mind, but you look at this one with 4, you can start to move money from the business and from the SSAS itself, from one member of the family to the other. Now, of course, in this kind of cartoony situation, you've got to imagine that these are kids over 18, right? They're not little kids. And essentially it means you can start to build tax-free pots and move them from so you don't get lifetime allowance problems. Lifetime allowance is the maximum you can have in any pension before you start to attract some potential tax. It's somewhat complex, but nonetheless.
Would this diagram, sorry to interrupt, Kevin, just to kind of confirm this diagram, is this based on, would this be a SSAS per person, or is this how you can structure your own SSAS?
Yeah,
one per family,
you're
right?
not paying
Fantastic.
multiple costs, right? So with a SIPP, you'd probably, you know, if you had a SIPP here, you'd have 4 SIPPs.
Yeah, right, okay.
Yeah. And for running
Excellent.
costs, SaaS, it's
Yeah.
one SaaS, one running cost, but you can start to shift money between members of the SaaS, and also the company can make contributions down each line. I mean, there is a special consideration where, in unusual circumstances, a company who has a fantastic year, can make a one-off contribution of £500,000 and get tax-free that source immediately. You can't do that in a SIPP. It's just not possible to do it. So, hopefully you're getting a sense of some of the key differences, and I'm sure that always leads to
And are you able,
questions about that.
do you have to spread that across all of the family, or are you able to pick your favorite kids? I'm just thinking, when I add mine on.
I don't know about that, Stephen, but there are ways that you can do what you want to do. This is obviously showing them as equal, but you don't need to do that. Often you'd want to make use of your spouses first, and then children after that. But the whole idea, anyway, just by illustration, is you've got a bit more control over the lifetime allowance. And think about a different way, So if this guy here with the beard was full up and needed a loan back, right? So he loaned money to his company. Let's assume his company was bottom left, just down below here. If he loans that money to the company, then his pension pot essentially then is moved some of the money out, right? Although it's still a loan, so it's still in his pot, but the growth and the proceeds from that can go down the bloodline of others. So you can make profit in the company and then drop that down into other people. So it's an intergenerational tax planning tool from one generation to the next. Now, all pensions are free of, free of inheritance tax, but as I'll mention in a few moments, sometimes they're quite different. So a lot of people will ask me, what's better? What would win? You had a boxing glove at the beginning there. What would win? And this is just a joke. I love it because a lot of people think I look like him, Harry Hill. There's only one way to find out who wins anything. Fight! And who would win? Well, I don't know. I was joking apart. I don't know who would win. For everybody, it would be different. For some, it would be a personal pension, a stakeholder pension, or a workplace pension. For others, it would be a SIPP. For others, it would be the SSAS. And it just so happens that in many of the people that we deal with, and we're now dealing with the community now. So we have a community called the SSAS Alliance, which is now 4,000 strong. So there's a movement, Stephen, being created, and thank you for putting some acceleration in your own business power behind that, and I'm grateful to you for that. But the power is, we're both trying to create a movement of things that are good for people. Like I'm trying to do this for SSASs, for those who it works for, and you're trying to do it particularly in the peer-to-peer market, where there's just struggling to get the traction with SIPP providers. So I don't know who the winner is. But in any case, it's worth saying, well, how do you determine whether you're eligible? And with a SIPP, you just take it off the shelf. Yeah, you're just borrowing somebody else's box. So there's no eligibility criteria. You just do it. With a SSAS, you've got to go through an HMRC approval process. Okay, so there is a process, and it takes about 90 days. And in broad terms, I talk about 5 eligibility questions. Do you have a business? Got to have a business. Are you proactive and willing to take control and willing to be involved in your pension? Because you need to spend some time. I'm saying an hour a week. Are you willing to do that? If you're not, go and do a SIPP. Are you? Do you have a legitimate source of money? Like, have you got a pension that can be moved, or you've got profits in your company that can be moved? Have you got a plan that can be executed? Well, I'd like to buy a Ferrari. Well, you can't do that in a SIPP or a SSAS. I'd like to buy a building and convert it into apartments. You can do that in a SSAS. So, we need to see a plan. And then finally, we always do a cost benefit analysis. So we look at what they're paying now, what their returns are now with whatever service they've got with their pension, and then compare that to a SSAS, including all the fees, which would be absolutely fully and transparently disclosed. And if it doesn't absolutely convince them one way or the other, you know, if it's not a no-brainer to a SSAS, then don't do it. If it's a no-brainer, then do it. It's a matter for you to choose. And we do those cost-benefit calculations every day, and we've got a whole team of people who do cost-benefit calculations. So anybody wants that, it's free to do, you know, because we want people to look at it, not to persuade the wrong people to have SSASs. We definitely do not want to do that, because we want SSASs to stay. They're so powerful. We just want them to work. So we don't want them in the hands of people who are less able than they should be to handle it. You see what I mean?
Absolutely. Yep.
Yeah. So not all SSASs are the same, by the way. So we do have a little guide that we're willing to give away, plus the video, the 7 key questions to ask before engaging with a professional in SSAS, or anybody who's talking to you about SSAS. There's some really important things. I won't go through the 7 key questions now, Stephen, because we'll be here all day, but there are definitely some key questions, good due diligence questions that you should do. And so if anybody kind of wants to connect with me to get those resources, the 7 key questions, which is a video, and myself and my SSAS director have created a video called the 10 differences between SIPP and SSAS on a proper video. Do people get this recording if they want it as well, Stephen, or not?
Yeah. So we will share this recording around afterwards as well. So
okay.
to make that clear for everybody.
Yeah,
so
and
they'll be
so
able to
anyway,
see the resources
we
page.
go into a bit more detail. It takes about an hour. So we've done that. And all they need to do is just register with a unique page that's just for sourced listeners or followers, wealthbuilders.co.uk/sourced. So, you know, hopefully that's at least stimulating people to start asking questions of their own, because I won't have covered all of them, and I'm sure I've stimulated more questions than I've asked. But I hope it was useful, Stephen, to get at least the debate started. How about that?
Yeah, absolutely. No, really good insight as always, Kevin. Really appreciate it. One of the things we've done, obviously, we knew we were going to get some great content from you, but we also thought it would be great to get somebody on board who is kind of going through that process and looked at the options, and that's hence where Colin's kind of come in. So I know we've got a couple of questions some questions are actually sent in as well at some of the points. So this is probably one for yourself, Kevin, before we jump into Colin. But in terms of who takes control of investment portfolios for SIPP and SSAS, I'm guessing you kind of touched on this, didn't you, in terms of, and you made it quite clear ultimately that, with a SSAS, it's you've got control, you own the asset ultimately if that's the investment you make. But with a SIPP, it's kind of you're a beneficiary. Is that the term that you used? Yeah,
you're the beneficiary. Somebody else is the trustee. So a bit like the vehicle, so if we keep that vehicle analogy, somebody else is driving the vehicle and you're sitting in the passenger seat, but the vehicle can only go in 2 directions, stock market or commercial property. If you want to do anything else, it won't even go there. Whereas a SSAS puts you in the driving seat, and you can control, and you can go where your capability allows you to. You could say, can I do a commercial to resi conversion? Do you know how to do one? If you don't know how to do one, it's not going to let you do one, because you've got to be able to demonstrate that you know what you're doing. Back to that point about the risk. Risk is when you don't know what you are doing. So most people are starting to take more control over their wealth, learning more things, and collaborating with more people to be able to learn how to do more. And then the SSAS will help turn money that was often a part of their past, when they weren't learning, into a part of their future where they are learning now. And it can constantly keep up with where you're going. Whereas generally speaking, the SIPP is going to be 2 tracks: turn right for the stock market, turn left for commercial property, but somebody else is always driving. It's never you.
Yeah, no, I think it's a really key point. Absolutely. One of the questions we've got, well, actually, we're going to jump on to find out a bit more about yourself, Colin, I guess. Ultimately, you gave us a great introduction at the beginning. and it was really interesting. As I said, I think you'd have won SIPP and SSAS bingo because it seems like a really good mix of experience. So I don't know if you're able to kind of share with us a little bit further in terms of what your journey is. I think I've skipped the slide, so apologies. Yeah, you know, first of all, let's start with why did you decide to transfer? What made you look into it further, etc.?
Yeah, thanks, Steve, and thanks, Kevin, for a very interesting presentation. Yeah, I mean, I've been through it all, I suppose, because as I said, I used to run a company, a software company, and I made quite large contributions into a standard pension scheme. It was buying stocks and shares through unit trusts, which are quite expensive. And at some point I decided, well, I've got all these different pension schemes, all the different pots. I need to do something with them. And I heard about SIPPs at that time. I don't know whether SSAS existed. And it was a relatively simple procedure to transfer everything into a SIPP. So I combined everything together and I looked at what I should buy. I didn't really want to go into stocks and shares. I didn't really want to go into offices. I looked at care homes, and the particular scheme advisor I went with said that they wouldn't do care homes because it was too high risk, but hotels was okay. So I ended up with a hotel, which I ran for 5 years, and I said I sold it and the money came through back this year. And I then invested in some stocks and shares in some of my brother's companies, which were going to do very well. I couldn't go through the initial public offering, but I could buy them once they'd been listed. And that was all good, but it was quite difficult to deal with. And as I said, I was looking at things to do for myself and my daughter, having been in property development for some time. And I came across SSAS's, and I spoke with John at Sourced and said, well, can you give me some ideas of which SSAS's might be useful to do? And he gave me a list of 3 or 4, and I started going through them. And I rang a couple of them and got on very well with a particular company, and was able to discuss what I could do with a SSAS, which I couldn't do with a SIPP. And I'm very much against paying tax. I like to avoid tax as much as possible, as Chris already knows, because we're looking at other things as well. And I worked out that with a SSAS, I could go into residential, albeit I couldn't hold it when it was still, well, it had a kitchen or something like that. I had to deal with it at that point. And I could do peer-to-peer, but also with peer-to-peer, I could use ISAs. And I'm in the fortunate position that my pension scheme is pretty well full up. So I didn't really want to make too many investments in the pension scheme, produce too much money from that way. But I wanted to be able to produce it where I could get at it, where I wouldn't have to tax as well. And the combination of using a SSAS to lend money in to do a development and have an ISA tacked on, which allowed me to then take the profits out within reason, seemed like a perfect way. And it allowed me to deal with commercial, it allowed me to deal with residential. It also allowed me to do cash release if I wanted to, but I also could take loans. So there's a property, for instance, I'm looking at shortly, which is about $500,000. And in theory, I could borrow money from a normal mortgage lender, and with the SSAS owning the property, which happens to be commercial. And at some point, I could then convert that into residential. So it just seemed like a really good way to do it. And the procedure was simple. Having made the choice to which company I was going to go with, I then had to pay them some money, and they then set up. We went through IDs as normal, and then we went through some basic information. But what I like best of all, and I don't know whether this is because of COVID, but we went on to a video chat. I gave them control of my computer and we logged onto the HMRC website. We filled in all of the application, and so she was able to talk me through all of that, and then submitted it. After that was done we then had to put a business plan in place, which they wrote for me, and obviously asking me for the input for that. That's been sent off, and unfortunately, we're now still waiting on revenue to do their checks and balances, and I understand they're about 3 months behind. So stuff that was done in January, February is only just coming through now. Mine was done at around March, April time. So hopefully within the next 4 to 6 weeks, that'll come through, and I'll actually start using for what I wanted to use it for. And that's where I am today.
Excellent. So you've kind of been through the whole loop, and I guess really kind of take you from that, Colin. You've looked at it really because it opens up, really kind of echoing what Kevin's been saying in terms of just the additional options that you've got to maximise what you can do with the SSAS compared to the SIPP. Particularly now you've kind of come more into property and property development.
Well, absolutely, Steve. I mean, it allows me to put my children in there, and I've already opened up ISAs for them from that point of view. But I will eventually start putting stuff through the SSASs. It deals with inheritance tax anyhow through that part of it, although it doesn't deal with all of AHT, of course. But it's certainly a good help and a good way to go forward.
Yeah, fantastic, excellent.
The point, if I may, there as well, that when you realise that your SSAS can follow you and open up doors in the direction you're going, so Colin's learning about certain things, as he said, he was curious about things, and then the pension allows you to do it. It becomes a companion to your own transformation. It allows you to do that. Whereas generally speaking in a SIPP, you're told no a lot. You can't do that, you can't do that, you can't do that. And you stop thinking about your pension as a vehicle for changing you. It suddenly just becomes a pot of money that's do not disturb till later. And because of this ability to bring in your family into your vehicle, it genuinely therefore becomes a collaborative family tool, which means you leave a better legacy. Because usually a lot of people don't realize this with SIPPs, is when somebody dies in a SIPP, you don't own the trust. So what normally happens is the trustee pays the money out to the beneficiaries. Now the beneficiaries have got the money, and then it potentially subject to taxes, whatever they do after that. So there's generally speaking, not very much wisdom transferred. Whereas with SSAS, you're keeping the trust alive. The kids become trustees themselves. So they become the custodians and the guardians of the money. So the money doesn't need to be paid out. They can continue to embrace it and to even grow it. And their lifetime allowance isn't affected by your death. So there's so much more power to it when you get into the legacy, which is a really important thing to me, because anybody who knows me knows, the reason I became a wealth builder and got so focused on it was the early death of my father. So, I wanted to become financially independent young because I didn't think, I'd survive to an old age. But looking at me now, you can tell I'm a wizened old bugger. And, I did survive him. He was 46, and I'm way past that now. So I'm grateful for that, though, for the sense that the SSAS has allowed me to bring my kids into the wealth of the family, not just when dad's dead, we get some money, woohoo. It's, we've now got a family charter, and that charter gives them lessons and learnings that they can carry on and carry on and carry on. So the money becomes something. So in my view, the legacy is what you leave within people, not what you leave people in terms of money. And SSAS does that for me. And that's why I'm so pleased to always even be evangelical about it. So I'll get off my soapbox now. Thanks, Colin. That was really interesting.
No, that's all really interesting. Like you say, legacy is such a big thing. I think you hit certain points in life, and even with goals like what Colin's talked about as well. I mean, you do start looking obviously at family and legacy, and planning is really key. And SSAS is just a great tool to do that. So absolutely, I think the more we can echo it, the better. In terms of returns, was that a key driver, Colin? Did you find that was something that drove your SSAS, or was it more the freedom? Was it more the you mentioned earlier about being you said tax avoidance. I don't think we're allowed to use the avoidance word, but efficient with tax.
Avoidance is good, evasion
you can't use.
Evasion. Oh, right, okay.
You're allowed to avoid tax.
Avoid is good, Colin. We and I agree on that one.
Yeah, no, it's very much become a tool, because you can have a large amount of money within the SSAS, and as I said, I don't particularly want to make interest on my SSAS, but I do want to make money. you know, if I draw down money from my SAS, I could be paying tax. But if I can do it so I give it to peer-to-peer, for instance, with yourselves, and I put in some money from the SAS, but I say, look, actually, I want the money to come out, I want the gains to come out into the ISA that I've also appended to that project, then I can take cash-free money from the ISA. Now, with an ISA, I can just take money and it can be in my pocket. I can return it within the same tax year and it's still within the ISA, but I've had to pay no tax, no national insurance or anything like that. So it's a really useful tool from that point of view, which I could never do with a SIPP.
Yeah, absolutely. That's the power of putting them all together ultimately, isn't it? Using multiple vehicles. You touched on that obviously in terms of source, and obviously one of the reasons we do this is to talk about our peer-to-peer platform and compare investments and returns as well. So you know, if we look at typical pensions, an average return of a standard pension is typically 4%. Stocks and shares average typically 6%. Whereas source we offer based on an investment of over £20,000, it's a 12% return. So really good returns there. You mentioned about the peer-to-peer, so that's how we structure it and how we work with investors, and they can invest with their SAS into the peer-to-peer platform. So it drives great returns. That's one of the reasons obviously people use it, as well as the flexibility. This is an example of one of the projects that we've worked on, a completed example. It was repaid to investors as well. So this is one of those projects that when you look at it, you can't believe it's the same property in terms of you know the actual driver behind this. The developer borrower took this bungalow, which you can see there in the bottom image, and literally built it up, extended it, and converted it to this beautiful detached property. So it's sold very, very quickly. It's a great example of one that we've funded using investors. There's quite a lot of SAS investment went into this particular project. We provide a kind of breakdown and overview of figures of where the loan is, how much the GDV is. And this is kind of a snapshot really ultimately of what's offered in the loan security as well. So first charge on all property investments that we have. And ultimately it was a sale, conversion and sale. So a little bit of a snapshot really, I suppose, a little bit further information in terms of the breakdown of cost, how much is being injected in from the borrower, the profit margin at 21%, and the loan to value against the GDV of 66%. So a little bit of an overview. I know we've overrun a little bit, so I'm not going to go too much into detail in terms of the growth, etc. of this particular property, but it's a snapshot. That's the idea of this, is to give you people that are watching this for the first time. I know we've got quite a few questions as well, so I think it's probably better to jump onto some of those so that we can advise on them. I'm just going to come towards the end of the actual presentation and jump into the questions. So if anybody's interested in investing into peer-to-peer or property in that way, utilising the SAS, they can also email investorteam@source.co, speak to one of our team. They can fill out the form online that we have on our website. We contact your pension provider. If it's an investment you're looking to make straight away, you choose a project to invest in. Your capital interest is paid tax-free to your source account then, and then repaid back into your pension, into your SAS. So that's the general flow of how it works from an operational point of view. In terms of security, so we offer first charge security. We have a maximum loan to value of 70%. Very open and transparent on the platform, so you can see all the documentation there. Regulated financial services firm, appointed representative. We only fund projects that obviously gone through a full appraisal, underwriting and credit risk approval as well process. So have a look to see the sort of projects we've got there. Again, the sort of snapshot from an FCA point of view. We don't charge fees as well. So one of the points that Kevin mentioned earlier, more on the SIPP side, you know, we don't charge investors fees. It's just the return. So they invest over £20,000, it's 12% return per annum. So great return there. We've got a poll that keeps popping up, but unfortunately, I don't think it's set up correctly because it's not showing us the button there. So we'll make sure that's in place the next time. And we're going to jump onto some of the questions because I see there's quite a few listed there. So bear with me 1 second, guys. I'll start up at the top. So yeah, one of the questions obviously about Kevin's books. So Kevin's touched on those. You've got 3 books out. Is that correct, Kevin? Is it 3?
Yes. So yes, I've got 3 books. each on different subjects. You know, what one is about being debt free for those people who that's a passion from them. Another one is on how to build wealth in multiple streams, and the other is, if you're a business owner, how to create streams of income both inside and outside of your business. Now that's waiting to be launched, that one, so that's not free, but the other books are available. Or so anybody who wants to do that, just go to the link that I gave earlier on, wealthbuilders.co.uk/sourced, and then just send us a note, say, can we have the books, and we'll send you the books. There's really no problem. I'm always willing to give away stuff.
One of the questions that's popping up as well is, sorry, Kevin, I think it's a bit of a lag down. One of the questions that's popping up is in terms of, we've talked about converting the SIPP to a SSAS. People are asking it, can you just transfer your pensions, normal pensions, straight to a SSAS?
Well, you've got to go through those 5 eligibility tests, first of all. But some pensions can be moved and some pensions can't be moved. So pensions that can't be moved, for example, would be public sector pensions, blue light pensions, military pensions, civil service pensions, that sort of thing. But if it's a conventional pension, it's measured by a value, and the value fluctuates from time to time. Usually you can move those. But we all also need to assess whether, you know, anybody who's looking at this, high net worth or sophisticated, in your experience, because, you know, sometimes when we look at a pension, there's some complexity there, you know, and we need to actually get you to give advice, to get advice on it. So it's not just a case of go get a SSAS, you need to be eligible, go move your pension needs to be eligible. I definitely don't want people to think that this is a breeze. It isn't. It's serious stuff, and it needs serious people, and you need someone to look at it with you. Otherwise you could get yourself into difficulties, and we don't want to do that. As I said, we want this to just work for people, not to get people kind of caught up in some sort of hype about, you know, SSAS is the best thing since sliced bread, so let's do one. No, you need to check your eligibility. And I mentioned those 5 areas, like 5, you know, we kept cars going. Imagine like the Formula One, we want 5 green lights. If we can get that, we're good to go. And we give a promise that everybody who gets 5 green lights, there's no cost if the revenue don't agree. So we've got 100% success rate with the revenue, and we're willing to commit to that. So I'd say just get in touch and we'll tell you if you're eligible.
Excellent. Another good question's coming. If I am the child in the parent's SSAS, can I have a SSAS of my own with my own family? You
can. Yeah, but we've got intergenerational SSASes. That's a pros and cons of whether you want 1 or 2. Not an easy answer until you know the family and you know the value of the pensions within the family. But it's possible to all be in the same one. You know, we've got a family with 9 members in it, so that's doable.
Right.
So just pros and cons, really. Don't know the answer, but either is possible. But you don't want to be paying fees you don't need. So as long as the benefit to you outweighs the cost, then you would consider it. Otherwise, you could do it all in one. And dividing 11 people into, or 10 or 11 into one, makes a SSAS very, very cheap.
Yeah, absolutely. A quick question from Richard. Is it possible to start a SSAS if you're from the UK but resident overseas?
Well, the issue, again, going back to the limited company, is you need a UK limited company. And in order to even think about any kind of a pension, you want to be offsetting some sort of tax relief. And so you need to be paying tax to offset it. Otherwise, why would you go through the process of having a pension when you wouldn't get tax relief for it? So there's an interesting question. If you've got a UK property company, but you live abroad, you could do that because you're paying corporation tax in the UK. I've got some clients, when they live abroad, they do something called a QROP, or a qualified recognized overseas pension, a kind of a fancy tax-free pension. And then if they decide to live in the UK, they can repatriate it. They're just pros and cons, and I can never be definitive on something like this without somebody in front of me. But it's possible.
No, that's fine. Another question as well is, I've got £20,000 in my SIPP right now, is there a kind of minimum level you'd expect for a SSAS?
Well, not really, because I mean, we do SSASs with people with zero pension because they've got a profitable company and they want to shelter some of the profit. And remember, a SSAS is for life, not just for the next few months. So if you've got a sum of money, a bit of seed capital, a bit of fuel, and you do a stock market SSAS, say, you know, or just something simple, you know, we have different levels of cost from 500 quid up to a couple of thousand, depending on the complexity and what you need to do inside your SSAS. So it can be very cheap as long as you're the right kind of person, right? And then, but sometimes it makes sense just to stay with what you've got, build it up to a certain point, and then you've got enough knowledge and enough time to be able to use it. The answer is always, it depends.
Yeah, fantastic. Look, some of the questions that have come through as well, guys, we've answered. So if you've missed part of it, you'll be able to jump onto the recording. We're going to send the recording around for everybody. But yeah, lots of really good questions there. We appreciate it. I know we've got an event as well. There's obviously some free resources we have on a resource page where you can go on and download any podcasts. And there's a few podcasts there with Kevin as well. So where he answers some really good questions. We can kind of have a few different options and topics, etc. We've also got our next webinar. So I mentioned at the very beginning, this is a mini series of different webinars, what we're focusing on. So the next one is using other people's SSAS for funding your property. That's on the 25th of June. So if you get a chance, you can book your seat there, and there's the mini link there in the top corner. So again, we'll email this around so everybody can register in time for that one. We've got an event coming up at the Belfry Hotel, so Birmingham, Thursday the 24th of June. So if you're into property investing, or you'd like to learn more about SSAS or just investing generally, again, it's a great event you can log into, come along, meet like-minded people. We actually get quite a lot of people who don't even play golf come along for a coffee and just sit down and have a chat with everybody that's there. So lots and lots of experience in the room. There are limited spaces, but if you check out that as well, be able to come on board and meet some of the team. So finally, just a big thank you to the two gentlemen that we've been today, Kevin and Colin. Really appreciate your time. Gave us lots of really good information, lots of a good insight, I suppose, ultimately. So we do appreciate it. I know you're both very busy, but yeah, really interesting to speak to you both. So thank you very much. Yeah,
I'll make one final point, if I may, which is the purpose of things like this is to get you curious. It's not to get you to be an expert. So, you know, let that curiosity move and just find out a little bit more. If it's for you, you'll know. If it's not for you, you'll know. Nobody's going to try and pressurize you or push you in one way, shape or form in the same ways you don't do with Sourced on your peer-to-peers. Here's what it does. Does it suit you? If it does, great. If it doesn't, you can invest your money in some other places. So,
yeah, absolutely.
Yeah.
Absolutely.
Don't try and be an expert on something complicated in half an hour. It's not going to happen.
Yeah, no, absolutely. To find out more information going forward. So, no, it's brilliant. Thank you, Kevin. Thank you very much, Colin, as well. Appreciate your time, gents, and have a great day. Thank you, everyone, for watching. Look forward to speaking to you again in the future. Have a great day.
See you. Bye-bye.
Thank you. Bye-bye. Bye.